Business news on the programme now. Stephen Carroll's with us here in set. Stephen, you're starting in the US today, aren't you? Changes to the rules for banks. That's right. Congress has passed the final stages that will remove some of the rules for the banking industry designed to prevent a repeat of the 2008 financial crisis. Now, Donald Trump had described the DoddFrank law as a disaster, but a bipartisan deal will only see some elements of the regulations removed. The compromise will mean that smaller banks will escape some of the more onerous rules, but it maintains the Consumer Protection Bureau in its current format. Georgina Robertson has the details.
The Dodd-Frank law was a set of rules designed to prevent the mortgage meltdown and subsequent financial crisis of 2008, which triggered the collapse of the investment bank Lehman Brothers, saw massive bailouts of financial institutions and a global economic downturn. Critics see legislation as punishing the regional and community banks. Paul Ryan, Speaker of the US House of Representatives, lauded the bipartisan agreement.
The House just voted to free our economy from overregulation. Mainstream banks are engines of growth, and it will now be easier for these banks to lend to small businesses and families.
This new bill rolls back the Dodd-Frank law in three key areas: mortgage lending rules, financial stability regulation, and bank capital requirements. Only big banks are deemed a threat if they fail. The bill's most significant provision raises the asset threshold from which banks automatically face stress tests, capital liquidity requirements and other rules to $250 billion from $50 billion. This cuts the regulation for smaller institutions. This leaves 13 banks where the Dodd-Frank protections will still apply. Though the US has over 5,000 banks, these 13 account for over half of the sector by assets and deposits. Those who oppose the bill point out that 25 of the largest banks, no longer subject to the same legislation, collectively hold around 1/6 of the assets of the entire US banking sector. These banks took $47 billion in bailout funds during the 2007-2008 financial crisis. The Federal Reserve has retained the authority to apply tougher standards for banks with over $100 billion in assets, where it sees fit.
Well, a little earlier we spoke to Oriana Liza from CMC Markets in Singapore about what these changes will mean for the banking sector in the United States.
Banks have reported profit earnings above 28% year on year, which has absolutely smashed earnings in the recent times. I guess the nature of the cuts surrounds the capital adequacy, but also the frequency in which banks will get stress tested, but more so for the local regional banks. Now, looking at that, I guess the larger financial institutions, which suffered amid the global financial crisis, are actually licking their lips when it comes to this. They're getting further support from the regional level, and should this actually be a positive move, it could actually move towards less regulation for the larger institutions.
Well, let's check in on what's happening on the stock markets for you today. We had falls on Wall Street in trading yesterday and in Asia earlier as well. The European markets opening in the red as well. Comments from Donald Trump yesterday that he was unhappy with progress in the trade talks with China appeared to be impacting investor confidence. The FTSE MIB in Italy, that's the Italian market there in Milan, also down by over 1%. Of course, continuing political turmoil there. Over in the Asian markets, we had falls there too. Of course, those comments on trade not going to go down well for Asian investors. In China, though, shares in car makers also falling. That's after the Chinese government announced they were going to cut the import tariffs on cars. That's a move, of course, that could see those companies face stiffer competition from foreign models. That's the picture on the Asian markets. Well, here in France, rail passengers are facing their 21st day of disruption since last month, as workers at the National Train Company continue their strike action. 40% of high-speed TGV services have been cancelled today, as well as around half of local trains. SNCF workers are unhappy with the government's plans to overhaul the company, which include preparing it to open up for competition. The bill to reform the railway is being examined by a Senate committee today. And finally, for me, it appears that even Amazon has its limits when it comes to fickle shoppers. The Wall Street Journal reporting that the e-commerce giant has banned certain customers from the site for returning too many items. They discovered that in some cases, users were blocked from making orders after returning as few as 5 items in 2 years. Others got letters like this one asking them to justify why they were returning so many items ordered on Amazon. The company says the action is rare and only happens when someone abuses the service over an extended period of time. But it's sort of the basic idea, though. You're ordering something on Amazon, try it, you know, send it back if you don't like it. There are limits, Stuart.
Exactly. I'm going to have to be careful. Watch out for that one. Steve with business.